My name is Kwame Rino from the Institute of Economic Affairs, and I thank you for being here this morning for this conversation. It's the 26th of June, 2026. The budget was read about 2 weeks ago. In that time, of course, the Minister for Finance presented not only the spending proposals, but also the taxation proposals. And we know that earlier this week, the President assented to the finance bill after it was passed by a majority of members of Parliament. Now, so that means that the budget season is now fully on course. On the 1st of July, the new financial year will start with new budget laws, together with, of course, a new finance bill. Now, whether we should have a new finance bill every year is a question that many have placed before us, for public discourse. Why? Because of the adjustments that are made every single year. But the IEA has been following over the last year and a bit the progress of Kenya's structural transformation, and we understand that fiscal policy and how budget is executed is an important way, or rather it's an important anchor for how Kenya's structural transformation will occur. And so we are specifically concentrating on the manufacturing sector, and we've had a series of conversations which we call Industry 254. And the function of that is basically to raise the profile of the manufacturing sector, to identify challenges for its growth, and also opportunities for employment that may exist, together with, of course, trying to elevate policy discourse in a way that actually meaningfully recognizes the need for structural transformation and the significance of that sector, based on the fact that Kenya has been undergoing the industrialization. In other words, the size of the manufacturing sector relative to the entire economy has been shrinking, and more recently came to about 7% of GDP, slightly less than 8%. So that's basically the idea. And our interest in Industry 254 is that basically structural transformation, which is the change in the structure of the economy in terms of where value is created, but also where people work. And the majority of Kenyans working in the agriculture sector, they work in the agriculture sector characterized by a big difference in terms of the most productive firms, and some of them are not as productive. So the idea is that Kenya's growth and future development is dependent on finding labor choices or employment choices in sectors that have higher productivity, which will provide higher incomes, obviously useful for Kenya to meet its Vision 2030 and other transformational goals towards prosperity. So that's basically why we're here. We don't have to speak about why the budget is important. I think Garment spoke about it last. The Cabinet Secretary has made the speech in Parliament, but we've had the appropriations from April, the end of April this year, and they've been discussed quite a bit. But in our view at the Institute of Economic Affairs, it's important to discuss both how government finances its expenditure, taxes, obviously, and borrowing, and at the same time, what it is spent on. And that's a conversation that should go on, in my view, and not just be centered on the first week of the budget speech. But here we are. So today, we are asking ourselves that the government of Kenya has introduced a very elaborate finance bill, and the finance bill is that taxation proposals with the government, which the Cabinet Treasury presents to Parliament. Parliament accedes to or not, but obviously they've always done that. And by that authorization, based on Article 209 of the Constitution, Parliament approving by law any tax adjustments, allows the Cabinet Secretary to go ahead. Allows the new tax measures to come to place. So what we're asking ourselves today is examining the last 3 years and looking at what these trends mean in terms of the taxation choices that government of Kenya makes and which Parliament approves and then implements through administrative tax administration authorities. What does that mean for a critical sector such as the manufacturing sector? Now, why is manufacturing sector important? One, the manufacturing sector is responsible for 16% of employment in Kenya's formal sector, so the wage economy, wage employment, so that's the first. If you take in the number of manufacturing enterprises that the government of Kenya takes, and therefore manufacturing sector as a whole, in the wage economy, comes down to about 11%. So 11% of people who are employed and have a regular wage, what we call the formal sector, are employed in the manufacturing sector in Kenya. At the same time, the manufacturing sector in Kenya pays close to 10%, 12% of all wages paid in that same formal sector. So it's pretty essential and big and important. So basically matching its scope, matching its share of wages to its share in the employment cycle, in the formal employment. So what we're trying to ask ourselves is that notwithstanding, and we've simply said that it's about 7.8% of GDP, what are some of the effects of government's fiscal policy choices, especially taxation policy choices, on the prospects, the growth, and investment in the manufacturing sector? So I have my colleague Leo Kemboi, who's a program officer in the IEA's Constitution Law and the Economy program, and anchoring the conversations that we've had under Industry 254 today. To make a presentation on what we'll be doing is taking a look back at the last 3 years, asking about what tax choices are made by 3 tax heads and what the implications of those tax choices are. One, for the manufacturing sector, and trying to isolate where there are reasons, the good, bad, and ugly, and whether there are reasons for reform of Kenya's taxation structure anchored on what its effects would be on manufacturing. So Leo, you're welcome.
The key aim of this finance bill is not to, of this webinar presentation is not just to look at this year's finance bill. It's to look at the trajectory of tax policy position. So what the key issue that we would like you to take from this is, where is Kenya's tax policy headed? And we are looking at the trajectory by evaluating the 3 finance bills, the 3 most recent finance bills. The 2, but the other one is the tax law amendment, the tax law, the Tax Law Amendment Act. So the key question is to ask ourselves, how is tax policy evolving, but how is it evolving for the space of manufacturers? Because the nature of manufacturing is that it takes a longer lifespan than most businesses do. Then secondly is that manufacturing, that is between 8 to 10 years to break even. But secondly, the most important aspect of manufacturing is that it's price sensitive. So you'll rarely find manufacturing segments that have significant margins. Majority of them have low margins. So you have low margins, so you are targeting a bigger volume. So any policy any form of barrier, of any policy barrier or any significance would affect manufacturing. So we look at the background, the 3 tax aids, as Kwame mentioned, the policy post, and then we'll go to the policy posture of finance bills on manufacturing. So first, the background is to set out the political economy question. So you all know that the MTRS has set out a policy goal to have at least 20% of tax to GDP ratio. The second key thing that we all know is that Kenya's manufacturing has witnessed this kind of a phenomena called premature deindustrialization, where the manufacturing sector as a share of GDP has kept falling over the last 25 years. So another thing that we all have to be cognizant in this background is that Kenya is a non-resource intensive state. So when we talk about fiscal policy and when we talk about revenues, we're actually talking about taxes. So it means that there is no substitution. So there is no, there are no other assumptions to be made about fiscal policy. So if it's a buffer, when we talk about buffers, or when we talk about the next question now, which is the fiscal crisis, adjustments have to be made on taxes. and taxes that are paid by farms and workers, and this tax burden is largely borne by the household. Another background question is the key thing about the procedure, which is now a procedural question about how Kenya amends laws. It's an omnibus bill. So legislation, policy has to be guided by objects, which is the reasons that starts. Policy has to be guided by objects, and the objects in this case are the reasons which actually provide for why that bill exists in the first place. So when you have an omnibus bill that amends several other legislations, and those legislations have different kind of objects, it changes their expectations on how, for example, on how public participation should be done, on what kind of informed discussion needs to happen on those specific legislations. But Parliament has kept with the finance bill, and the finance bill is the type of a legislation in most Westminster models of governance where there is a prime minister and a parliament. But if you look at those, like for example, the UK, the colonial power that governed Kenya before, if you look at the way finance bills are amended, there are guardrails. So for example, you cannot reintroduce an amendment on a specific policy measure which was passed in the last cycle. You have to wait at least for 5 other cycles. So there are many guardrails that have been introduced in how the finance bill is executed. So that's the background on which we are offering this kind of this analysis. Then the second question that we note is the frequency of amendments. Just stemming from that question of the finance bill, is that when we went to if you go to the Kenya law website, for every single legislation, it shows you how many times it has been amended. So you look at Cap 470, which is a Income Tax Act, and then you look at Value Added Tax, and then you look at Excise Duty Act, each promulgated, which each assented and commenced, which enacted in 1973, 2013, and 2015. You look at the number of amendments for the Income Tax Act, either amended through the Finance Bill, the Income Tax Act, or statutory or miscellaneous, other miscellaneous applications. Approximate number of amendments is 150. And then, which is like it's amended 2.8 times in a year. You look at VAT amended 29 times, 2.2 times in a year. You look at Excise Duty Act since 2015, approximate number of amendments, revisions. So you look at this for any form of when businesses are started or when capital outlays, decisions are made about capital, they are pegged on specific observations. But you look at this and then you realize that that you operate with the assumption that tax policy is going to change significantly. And that in the literature, and as we'll discuss later, those two go in a different perspective. And remember, manufacturing planning horizon is that you intend to break even in at least 8 to 10 years, or even sometimes longer for different forms of manufacturing. So this shows that there is a policy problem, a policy problem. So we'll go to the first one, which is the Income Tax Act. So the Income Tax Act, as 3 things that the last 3 financial bills has introduced. One is that the the policy is moving away from changing the rate specifically, but now it's moving to changing three things, which is the base. You're changing from the rate to the base, which is the from where it can be taxed. You are changing timing. The policy is also changing rules. So that's like our three form of three. We are observing those three things, and this is our reason. So one, for example, the investment allowance has been pegged at a max of 10 years. To apply losses, it has been pegged at a maximum of 5 years. So that they are changing how timing, the timing of how tax policy on the income on the income tax side is applied. The second question is for rules. So there are new rules which we call them broadly in the tax lingo, general anti-avoidance rules, anti-tax avoidance rules, which is so it includes things such as the top-ups, the significant economic presence tax, advance pricing agreements, they're raising compliance intensity, and so they're changing that. So on the base question is, so the policy is changing. So there was a specific way now. The those specific allowances and losses would be applied, and then there was also the different kind of exemptions, different kinds of these different kinds of incentives. So that is being shifted to now being narrowed, so that they want to raise the tax burden to be significant. Then you realize that, so for example, on the capital intensive, so you'll find that some of them would actually rarely exhaust that investment allowance, that deduction that is supposed to take place within 5 years, and they end up being unused. So that the indefinite carry forward is now being replaced with 5 years. So they are shifting the way tax policy is applied by shifting three key things. You are not focusing, they are no longer focusing more on rates, because that is the maximum that they can shift. And I don't think also, as we've discussed within our public forums before, there is no political coverage. There is no political capital that will be expensed on the rate. So they're shifting on the burden by widening the base, changing timing on how incentives are applied, and then introducing new rules on anti-avoidance, which is basically a way of limiting how you apply those benefits. On the other side, on the personal incomes, that was the company income tax. On the personal income tax, remember that personal income tax is still a significant share of all taxes, but also as a share of all taxes collected. So government is introducing, the government policy is now moving to offload certain specific elements of the budget and putting them as specific levies on the personal tax. So you see such housing budgets being substituted with affordable housing levy. Then you also see on the other side, on the healthcare side, you see a universal healthcare scheme, which is actually a tax on the formal sector workers. Then you see that 1.5%, you add another 2.75%, and then you also add a matching element on the NSSF. it lifts the total cost of employment on manufacturers directly. And then you also see that one thing is that the real take home is compressed without any bunch change, so that for those employees who are in the manufacturing sector, and generally all employees in the formal sector, in the labor market, that with that take home is all these has shifted the take home, and also the reliefs which were in the first instituted in the act was subsequently taken out. And that in itself has has raised the cost of employment directly. So the key thing here to observe is the cost of employment. Those obligations are captured by are already captured by employers. Another thing that to note, remember that all majority of Kenyan businesses are micro, small, and medium enterprises. And that also applies to manufacturing firms. You rarely find superstars, what we call a superstars equivalent, for example, to EABL and others, so that you say the employer has some margin to cover that. The second part is on the VAT, and the VAT is the most complex and the most controversial tax measure, especially to manufacturers. The design on paper is meant, the input output is meant to ensure that it's a neutral levy, it's a neutral tax. But again, there are three key things that you see from the policy. One is that the state the state under budgets, the state under the state already under budgets, because so the key thing is that VAT refunds, because it's an input output system, for those goods that are zero rated, the VAT that is paid in advance by manufacturers, they're allowed under law to recoup that and take it back as a cost. However, because of the backlog in the way that refund process is done, there is a substantial amount of backlog from the VAT refunds. So we've seen that part of it is the complaints by manufacturers on input VAT on that has gone unrefunded. And because once the Kenya's tax design is that once all revenue has been mopped to consolidated fund, unless it's up to the state the state agency, the state agency here in KRA to budget for those refunds, and so that for Treasury to budget for those refunds, so that they're able to go back, they're able to be refunded. But now the state has under budgeted for this, and we are going to show numbers in the subsequent slide. Second question is, when goods are reclassified, because there are three types of regimes: a standard rated, which is 16%, the zero rated, and then the exempt. Those three kinds of regimes are supposedly required to have same legal incidence. But what we see is that the economic incidence is different. So VAT incurred on inputs on exempt status become, for example, is unrecoverable and is buried in the cost base. So said, by just applying that VAT is changing the cost structure of production for different types of goods. So exempting one or zero rating another is a way, is the state's way of actually discriminating it. The three the third issue is that, and this is a complaint from the manufacturers in submission to Parliament, is that majority of issues on VAT refunds or rejections or any form of disputes relating to that has come from the fact that the e-teams, which is the invoicing mechanism, the custom system, and the ITAX operate on a different basis. So, and that's making reconciliation difficult. So looking at those numbers is that in the submissions to Parliament, that you look at what the Treasury has budgeted for the whole year, for the whole financial year, vis-a-vis the monthly claim of for VAT refunds is 5 to 2.5 billion shillings. So there is no time. If you look, this is a statistical issue. There is no time that Treasury's allocations will ever catch up with those claims arising. So we have to, so this is a design question that members of Parliament needs to consider, because this is a serious question, because the way it affects the performance of firms and also investment decisions. And then for the zero rating and exempt status. So there's in literature, you'd expect that this is just a more now going into the economic incidence. When a good is zero rated and input VAT is now recoverable as a refund, vis-a-vis when it's exempt and the input VAT is not recoverable, is a decision that members of parliament make when they when they amend the law. But again, if you look at the rubric, what is the guiding principle? What should be the guiding principle in how whether one is whether one is zero rated or whether one is exempt, and what is the general equilibrium result of that decision. So you might realize that input VAT, input output VAT, and the way VAT is expected to be tax neutral is now muddled by these two concepts, whether one is exempt or whether one is zero rated or whether one is standard rated. And this in itself, Kenya needs to move away from this, because we see some things like for sanitary towels, for example, are considered exempt. So you ask yourself, why would you require value add tax on? And then secondly, the nature of how manufacturing occurs is that global economies are now value chains. So one good might go through more than 6 to 10 countries before it becomes a final good. So you put in a regime like this, it makes it difficult for manufacturers to compete globally. And then again, VAT lies on top of other taxes, excise, import duty, railway development levy, import declaration fee, export investment and promotional levy. So it's a compounding tax. And when you had excise for the others, now it becomes a problem. Another thing is automation. Any form of policy problem in Kenya is always thrown, because look at this. The e-teams has been suggested as a solution to deal with invoicing mismatches, misapplication, fraud, and many other things, including making the process of refunds faster. But again, when you start to look at the way, so the policy, VAT is designed as a complex, administratively complex, and once it becomes administratively complex, it becomes difficult, and then it becomes difficult for KRA to administer it. Once it becomes difficult for KRA to administer it, now a technology solution is added on top of it, so that you see that e-teams require now what they call e-teams compliant invoices. And any input claim without matching electronic invoice is auto-flagged. But now we come back. The structure of Kenyan economy is that it's highly informal. It's highly informal. So your milk, let me give an example. You're in a factory, and you buy milk from a farmer. Now, to ask that and for an e-teams invoice for milk for a sector that is highly informal, it's difficult because those e-teams invoices makes the assumption that the credit note you've already been paid. Sometimes those payments never come to materialize. Even government institutions, you invoice e-teams, it becomes a pending bill. But KRA wants, so it's an automation. Once you realize that this is not a problem automation cannot solve, it cannot solve. It's a design problem. Then another problem that has come is the withholding VAT advances collection to KRAs, but leaves in an estimated 15 billion shillings. So automation has changed again the problem by compounding the issue. So when you know that manufacturing exports are low margin, high volume, and they are price sensitive, when you don't have, it creates this self-defeating loop where unrefunded input VAT raises the cost of production, then higher costs and cheaper imports erode competitiveness. Then again, because you lose money, employers do not want to export. And then that leads to farms export shrinking, farm production shrinking, which again lowers what government outlay is expected from that. So this is a challenge. For that self-defeating loop becomes a problem. So the reform measure is to there are two things. There is a decision whether that needs to be made, whether Kenya needs to have a zero rating when those refunds cannot be processed. So is it okay to have a 16% or an 8% VAT rate that applies universally, and there is no other offset mechanism that requires this administrative complex process that cannot be. So that's a question. But the key question is for that refund line to be taken out from the exchequer releases. So the next one is excise, and for excise tax is actually what economists call a sin tax, and it was conceived as a Pigovian levy, a levy on a narrow set of goods to internalize costs. And so you realize that now it's no longer on just this narrow set of harmful goods, but it's on other things such as financial transactions, among other things. telephony charges, among and other things. So we ask ourselves whether that, if by the tax policies just changing a specific policy metric to say not just correcting externalities, not just paying for the externalities, but to now include other things like not just paying for external, but to just raise revenue. So if it's just about raising revenue, it's now another sales tax. And once you expand those to production inputs like paper, glass, and everyday manufacturing goods, you are raising the costs on those specific on those specific manufacturing goods, especially where there is substitutes, people substitute, but where there is no substitute, those costs will shrink the market. So to give an example, on the alcohol, the undenatured extra neutral alcohol that is used for spirits, you find that before Finance Act 2025, which reduced it to 500 shillings, Kenya's cost per liter, tax per liter, was 964 shillings. Then it went back to 500. But even still, at the current presence, for Uganda, it's 89 shillings, and for Tanzania, it's 239. So it's double the Tanzania's cost. It's doubles the Tanzania's cost, but also it's 6 times higher. Even after that correction, it's six times higher, 5.6, so all close to 6 times higher than than what Uganda has. So that's why you see smuggling. And it's even worse. Those numbers are even worse when you compare for cigarettes, when you compare for other things like vehicles and among other things. So that regional arbitrage is because tax policy changed. Tax policy has changed substantially in a way that it's no longer about internalizing the costs, but it's changing market structure. Then we read another important case, the Kyo case at the East African Court of Justice. And then we also looked at the Finance Act 2026, the Finance Bill 2026, which now deleted the EAC origin excise carve out for 20 plus lines of products like glass, plastics, paper, furniture. But the big lesson is that the EAC Customs Union was to serve as an important stepping stone for a common market protocol, and to ensure that markets are able to function and Kenyan farms can compete across the region. But by that deletion will collide with an EAC, with also a standing court precedents, the Kyo case at the EAC Court of Justice, where judges ruled against that 25 glass bottle excise. But again, retaliation, when you reimpose that 35%, it invites the same challenge and possible retaliation against this input, against those inputs. So the key thing is the excise tax has changed substantially. And because the excise tax is meant to correct for externality, it's supposed to shift behavior. So you now ask yourself, what behavior is government policy trying to shift, for example, in the production of glass or paper or many other things, these 20 plus of those product lines? What's policy? Because it's clear, when you want to excise on oil, and there's an oil spillage in Makueni, you are supposed to take that excise collected from fuel and correct for that externality, which is environmental damages. Or when you excise tax on alcohol, it's supposed to shift behavior by raising prices to a certain level, provided it's within the left of the Laffer curve, so that alcohol consumption is reduced. Or when people get liver cirrhosis or many other things, you've invested in healthcare facilities that now allows for the correction of that externality. So the question is, what externality is government of Kenya correcting when it spreads excise tax on many other goods that are not harmful? So what is the policy posture? Now, looking at the three finance bills, is that policy is changing away from rates. So for those who watch policy, it's no longer about effective rates. It's about the base, timing, how those incentives are applied, and it's also about enforcement. So we didn't look at the Tax Procedures Act, but if you look at the Tax Procedures Act, the powers of commissioner has been enhanced substantially. The anti-avoidance rules, provisions on what is considered deemed distribution, shorter filing deadlines, and then it's also inward protection. Protection is now moving inward. So excise, for example, that had been extended to ESC origin inputs are now being taken out of the legislation. So this is the policy trajectory of the finance bill. So this is what, if you don't take anything from this webinar today, this is what we want people to understand. The four key things that, so the customs unions protections are now being redirected inward. Increased enforcement. So like, for example, Kenya wants to move away from voluntary to a dual mandate, where a voluntary tax declaration, to a dual mandate, where even the commissioner can originate an assessment, so that it's not just your self-assessment, including that one of the commissioner. And their reasoning is that they're going to use artificial intelligence, which is another policy buzzword that is going to be seen in the coming days. And then changing timing and now changing burden. So it's no longer about rate. So people look at rate, it's not just one thing. And then, so you look at the way that trajectory is deviating from the prescription, from the first principles prescription. So for example, Peter Diamond and Marlis, who both are Nobel Prize winners, came up with this, their work is cited more. Their work is cited more when people are making a case for VAT, the ad valorem tax, as a neutral tax. But again, their key issue was that tax final consumption. You don't tax intermediate inputs. And they made a demonstration on how, when you tax the inputs, how it changes, how markets shrink, but also why that is a suboptimal outcome. Then you preserve. So when you allow depreciation costs in law, depreciation costs or investment deduction allowances, for example, the Jorgensen, another economist, and who was and also the NBR director for the public finance, had a principle on user cost of capital. You have to preserve the present value of depreciation costs. So you see that these provisions that want to cap timing actually raise effective tax on investment. Adam Smith's certainty, second canon, stability, predictability, non-arbitrary rules, changes of rules, 3 finance bills in 3 years, and changing rules substantially breaches that prescription. The Martin Feldstein on best elasticity, or the Laffer curve. You have to stay, as you all know, the Laffer curve is the normal curve. You have to stay away from, you have to stay on the left side of the Laffer curve, because once you get to the inflection point, once you get below the inflection point, consumption reduces, and then corrective taxation. Excise tax is only for genuine externalities, and it's a narrow tax. It's for very few segments of very few taxes, and then other things on internal coherence. So you see 2 different policies. You have an SEZ Act, a Special Economic Zones Act, and then you also have you introduce an OECD like Pillar 2 tax on significant economic presence tax. Those two this tax collides with those incentives. So you find where a policy cancels each other out, while you are claiming that, while policy claims that it's supposed to move. So those two are self-contradictory. So I'll end at this, but the key question that I want people to understand is that the MTRS, the central medium-term revenue strategy, makes an assumption that there is a tax base that is fixed and exploited, and you can only, when you raise coverage and tighten enforcement, you'd be able to raise more taxes. Taxation in design, in itself, is that it's endogenous. It's also it's endogenous and also behavioral. So anytime you propose a tax measure, it changes behavior. When it changes behavior, people can either deploy more capital, or when you raise the user cost of capital, when you tax inputs, you raise the user cost of capital, and when you exceed the Laffer curve, you go past the inflection point, or you destroy certainty, production falls. So it's not a fixed. People need to understand, and I think that is something that, as economists, we really need to, or people who follow policy, that is something that people need to understand. When you change behavior, we were once given an example, and Kwame remembers that when the senator, for example, the millet, the one manufactured through sorghum, when the first time it was introduced in Kenya, it boomed. There was a boom. Then Treasury provided an excise tax, so it raised cost of that. It was a cheap beer. When they raised taxes on it, consumption fell in the next quarter. The first group of people to bring that proposal back to reduce taxes on that beer was the National Treasury. So the point is, you are changing behavior. Once it's not a tax that people, for example, when you tax more, people will deploy more capital. It doesn't work like that. People cannot lose money. So that rationality is something that people need to understand. So the short run basis that you want to raise 154 billion shillings vis-a-vis long-term projections is something that needs to be raised as a policy. I end at that. Thank you so much. Back to you, Kwame.
I think just to recap, or among the things that are told us is basically, there is no doubt about the significance of manufacturing for Kenya. I mean, it's a huge source of government revenue. It's a reliable source of employment. It creates 16% of employment in the formal wage sector, private wage sector, and then it's 11% for the entire wage sector if you include manufacturing services from the government itself. But so the question that Leo was placing before us is to ask, what are the effects of the employment? What are the effects of the fiscal policy, tax models, and laws over the last 3 years? And we can see that the Income Tax Act has 150 different amendments over its life cycle. The VAT Act of 2013 has had more than 29. And of course, the tax procedures and excise taxes have also had quite a number. So basically more than 2 tax changes per year. Now, 2 tax changes means twice per year the tax changes, right? If you add all that. So the first thing it tells you is that there's instability in the taxation regime. And then it traces the connection of this regular taxation to complexity of not just the tax system, but also its effects on manufacturing. Because if you change income taxes, it has significance for how the investment in the investment in manufacturing takes place, how investment is treated, and of course the depreciation and investment flows over time. So that's the first thing. The second is the taxation design is incoherent. So if you look at just taxation design on one side, for excise taxes, I think it's most salient, where you have excise taxes intended to cover for what economists call an externality. Then it becomes a revenue source on which government depends. So basically it means taxes are not just being designed to change behavior, even though they do change behavior, but government intends to rely upon it. And when those taxes then start to reduce, then what it does is an adjustment of taxes, an adjustment of rules, timing, and stuff like that, just basically to make sure that that revenue that was supposed to be used to correct an externality does not. It simply becomes a regular tax source for other spending. And so the 4 main ways in which those changes have occurred is basically headline rates are not changing much, but more often than not, you see processes being changed, everything being front-loaded and stuff like that. Timing being changed, and often timing being changed to the disadvantage of the manufacturer or the investment person. Raising enforcement by introducing more penalties, restricting discretion, raising upfront payments, of course, and as you can tell, for instance, in terms of new taxes and VATs being adjusted, and it's creating this distortion, or rather this complexity, where you have the zero-rated, you have tax-exempt, and you have standard VAT. And by changing one or the other of those rules, I think the sector that suffers the most from that instability, because when it says tax-exempt and it's zero-rated, it means completely different things, where in one case, the good is not subject to taxation, but the inputs that went into it are subject to it, and therefore recovery takes time. And as you can see, government plans for VAT refunds is 2.5 billion when the liability per month is 5 billion. So it means that stock of due VAT refunds will continue to grow, but it's even unfair because it means it traps the capital of manufacturers, because it makes it difficult to review, and it means, for refunds to be brought back. And what it means, the timing is not just inconvenient, but what it means is government is actually receiving a loan or credit for paying without paying any interest upon it. So obviously, it's, in addition to the fact that it's just inconvenient, administratively difficult to chase, but it's also a penalty. So that compliance actually exacts a penalty on farms. And we saw Leo give the example about where some of it is so difficult because in the manufacturing sector, especially in exports, it has the economic character of most exports globally tend to be very competitive. Why? Because the global market is big and everybody has access. Some of the rules at the WTO and all that allow for exports to go into countries. And therefore, competition is very steep. Why? because margins are small. And so the best way to make money for manufacturers is actually to have expanded output, which is basically volumes. So when you have that possibility of exporting volumes, you're competing on low margin sectors, and then you have to keep your money and try to get it back by the refunds problem working as it is. It's very clearly that it's actually a constraint on Kenya's export performance, which is both a limiting factor on the manufacturing sector in itself growing domestically, but also on ensuring export performance as well. And then more recently, government has started to go into protectionist measures, which means the government is actually tax policy in Kenya, proposed by the Treasury, approved by Parliament, and therefore Parliament bears responsibility because that's where the constitutional responsibility lies or authority lies, has the effect of actually violating Kenya's obligations regionally. So that you basically see that ESC rules, the common external tariff, and the common market principles are violated, all because government is trying to chase taxes or carve out specific taxes that it cannot forego, regardless, and therefore throwing away obligations that it has to partners within the EAC. So that's basically the rule. Now, Leos talks about some of the ways to fix that, of course. And as I've subjected this over the last 3 years, these to specific principles of taxation, even by Nobel Prize winners, and it tells you that Kenya's taxation in general, and especially that of our subject area today, manufacturing, is all over the place, incoherent, poorly designed, and actually affects long-term tax takers. So basically, it's anchored to collect as much revenues as possible today, but its effects on investments and on a longer-term tax take is actually defeats its purpose, because what it does is it delays investment, but in some places actually makes a rollback on investments and manufacturing sector. So we have a problem, and a tax reform, and broad tax reform in general, across VAT, excise taxes, and income taxes are essential to place Kenya's manufacturing sector on a more competitive plane. Now, I'll open up to any comments that you might have. So please, the toolbar at the top, the menu at the top, allows you to raise your hands or to send a question in the question and answers or the chat session. I haven't seen any questions so far, but what I'll do is I'll allow anybody whose hands are up to switch on your camera and unmute yourself and ask any questions or any comments related to manufacturing and the subject today. I can see one person is typing, but before that happens, do you have anybody whose hands are up? Let me see. No, I cannot see that. So shall I wait for Karani to finish up his typing? Okay, fine. In the meantime, anyone else who has his hands up? I don't see that. Let me check whether there are any other questions in the chat box or the Q&A. No. No, none. Okay. Yeah, there are no posts. Let's see. Is a question ready? Okay. Karani and Joanne, maybe you should just ask the questions orally. Just ask the questions, just unmute yourself and ask your question, since we don't have any others, and your typing seems to be taking more time. So it probably would be quicker if you simply unmuted yourself and asked the question. Okay, so Joanne's hands are up. So Joanne, please go ahead and ask your question.
Can you hear me? Good morning or good afternoon. I have not heard. Thank you very much for that very good, I'll call it awareness presentations. I have not read the whole finance bill as it is, and I realize that you're focused on, industrialization in respect to creation of jobs, and just the tax regime, whether it's good for that purpose or not. I'm wondering, is there space in there for cottage industries? We are a small economy growing. We need to create jobs. Is there anything that's encouraging that sort of, takeoff into industrialization in terms of cottage industries? I'm sorry, I haven't read the finance bill. Act in full.
All right, thanks a lot. So let's keep that question. Let me see whether there's a question from Karani. Karani, you're still typing. Do you want to ask your question as well? Okay, as we wait for Karani to finish his typing, Leo, please go ahead and ask and respond to Joanne's question. I hope you heard it.
Yes, yes. So the challenge is almost all these because the unit of taxation would be a farm, then definitely would affect these cottage industries. And just to bring to speed, Joan, all forms of Kenyan manufacturing is actually a larger part of Kenya's manufacturing is what you'd say small scale, like cottages in that nature, because the number of farms of bigger capacity of say more than $1 billion in revenue or $100 million in revenue are countable, and they would be even as a smaller share. So the challenges are still the same, would apply and are still the same. So, and we've looked at many other proxies. If you look at other proxies, it applies to the same. So what could be done around the same is to 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 set the principles first. And the original goal of the national tax policy was to correct the person who the National Treasury recognized that there is a problem in how tax policy principles are applied. And to get off that tangent, and because they want to raise investment, especially in these areas, like in those specific areas, it would require so that tax policy, but it ended up being a mishmash of the unwritten practice of what the treasury was doing into the same. So it never changed because it didn't change the cost. So the big solution is to go back again and redraft to make the trajectory of this finance bill to make to make the trajectory of finance bills or tax bills to be friendly to investment.
All right, thanks. John, I hope that answers your question. If not, you can add you'll add it a little later. But I can see Karani has a message here. And so, Leo, listen to this. Using AI as a means of enforcing or assuring credibility to payable tax. Really, when was the infrastructure advanced enough to have cybersecurity, electricity, and the inevitable unemployment crisis in Kenya? Who's assuring that we have safety with, in my view, imported AI, as none is Kenyan-made, backed or fully supported, I think, meaning we are adding administrative costs in the long run. Okay. Thanks for the question, Leo. Your comment?
That's a very good question, Karani. The first, the big policy issue is that we need to ask ourselves is, under the voluntary system of self-assessment, what was the result? Majority of tax collected today, I think more than 90% of all tax collected today is on a voluntary basis. It's somebody going to the computer declaring I paid this, declaring that I have this was my income, this is the tax due, and that's the assessment. That is the thing that has been working, and that is what works globally. And then audits is a way of following up on the same. But you see, in Kenya, because the tax system is becoming capricious, you see that they want to have another method of self-assessment where the commissioner can now originate assessments. And this is the part. So it's not something that models, it's not something that can be modeled. It's not. And then secondly, some of the what people call the tax that is not being paid is actually comes from the sectors that we call them auto tax. There are sectors that cannot generally, you cannot tax. So you might have 22.5% of all of all of the entire economy as agriculture, but less 40% of that 40% of that would be in sectors like that are smallholder. It's somebody going to the farm to dig up and it's their own effort. So those are things that even if you deploy AI, that tax will not be paid because that is personal. Somebody is using their own personal effort. They might not even be using they might not even be using fertilizer, or they could be using manure on many other things, and they might not even be selling those things on a formal basis, but even those exchanges. So we need there's this very sharp OECD kind of thinking that comes from a form of advanced markets, a tax structure for advanced market that is being brought here. So I have, even as we are asking ourselves, we are not convinced that self commission origination, that self-assessment, how much it will change for, because if you are collecting 90% of that tax through self-assessment, the problem is not the tax collection method. It is actually in other parts of the economy. And here, for us, we are convinced it's things like growth, it's things like FDI and many other things, not necessarily it's not a tax collection problem per se. So even that infrastructure that we say advanced, it's just looking at banking data. It's just to look at banking data. And there's a constitutional issue related to those questions, because for me, what I'm seeing is that it's a cop out from KRA to do audits, because they can do audits. They're mandated by law to do audits. So even members of parliament are convinced that there are many tax cheats, which we are convinced they are not. Then they should fund audits. They should fund audits and increase the scope of those audits. But they don't. So it's for us, the way the political economy interpretation of that policy measure of using AI, we are still for that voluntary self-assessment. And in absence of that, audits, they can do audits. They are actually required by law to do audits. Thank you so much. Back to you, Kwame.
So let me say this thing about what Leo has added. I think increasingly you see a tax system that's going away from not just the tax rates being raised sometimes, but I think because of a political economy constraint reinforced in 2024, Kenyans don't want higher tax rates, even if, of course, there's stealthy release of new laws which raise those taxes, but effectively raise those taxes. But I think one of the things that has also happened more recently, and Leo has stated it, is an increasing use of administrative measures that are more coercive. So basically, the coercive nature is restricting how much time people have for paying taxes, making their tax returns. And we are not too sure that there's nobody who say that is connected in any way to correlated in any way with tax returns. So for instance, I've always asked myself if say, for instance, the government of Kenya says that the tax returns are government plans on a year-by-year basis, and we understand the financial year is January to June. I mean, so June to July to June. Does it matter when people actually file their returns. And that's an empirical question. In my view, it's not a question that really says one thing, because I know Kenyans say something like all Kenyans, whenever you tell Kenyans, everybody files their tax returns on the final day. Maybe that's true. I don't think it's Kenya specific, it's natural human behavior. But I'm not too sure that when you file your tax returns correlates necessarily with when you pay your taxes, especially because most of Kenyans who work have their taxes taken on a month-by-month basis. Would it affect much more taxes? I'm not too sure. So the restraint that is being applied by making Kenyans now have to make their tax returns by by April, because hitherto we had to send it all the way by by June. Is that going to lead to more tax returns, or is that just an increasing enforcement being applied, which will necessarily also generate some delays here and there, so that of course penalties can obtain? So I'm not too sure. So we see changes in the tax policy and administration, which I'm not too sure are connected to increasing the tax take or closing the loopholes. But for some reason, that's one thing that we is continuing to apply. And then the second one is, as Leo has mentioned, I think one of the things that has happened as well is all taxes that the government of Kenya passes through the legislative authority in parliament should be paid. Should be paid. At the same time, we are asking ourselves whether, on the basis of principles and on efficiency, whether passing a tax that forces you to be in litigation for several years, a tax bill which forces you to be in litigation for several years, is smart. Maybe it should be collected in a different way, or for some reason, all that. So we understand, as Leo said, you have to be on the right side of the Lafar curve to ensure that you're not generating taxes or reducing economic activity to squeeze the last liter or the last shilling of taxes from people. So while we were speaking here about general manufacturing, there are specifically taxes that are related to manufacturing that we find particularly offensive. I use the word offensive advisedly. Offensive in the sense that for the very minimal taxes generated, the distortions it creates by delaying employment, reducing investment, and actually creating closure of farms does not justify those taxes, but it does. And that's excess tax, VAT, extremely onerous and very administratively burdensome, right? And then, of course, some aspects of the personal income tax. But the two that are most offensive, in my view, are the excess tax on one side and how they've been applied to manufacturing enterprises principally, and the value added tax, especially when you, not only is the tax high, but also it applies in a very complex way about VAT exempt and zero rating, all which have no generate burdens and obviously make the tax system even more administratively burdensome, but also more complex. And we're not too sure that it's very, very clearly an inefficient way of raising the revenues that are raised. So that gets me back to I haven't seen any other question, but that gets me back now to come to Leo for concluding remarks. And one of the things that I'm going to ask Leo to perhaps emphasize is what is a small smart program where we should actually have a tax requirement? Or no, would it work for us to have a tax requirement? So for instance, to persuade members of parliament. The members of parliament sometimes, even when they're representatives of the people, and you therefore find that they'd be more at ease with listening to people's reluctance or preference to keep a greater share of their income. Members of parliament seem to be more bullish sometimes than even treasury to raise taxes, because there's no tax that the treasury has ever asked them to raise. The executive amount that they did not want to raise, and actually even go much, much further, because they have a high appetite for spending as well. So Leo, I was going to ask whether you have certain proposals or ideas which would say, for instance, is it possible now for the parliament to maintain a rule for administrative tax purposes, which states that for every new rule that the treasury proposes to impose upon farms or individuals, it needs to balance that by taking out another rule to try for neutrality, but also that's the first. The second is whether the treasury could be asked again, or parliament on its own initiative should study what the administrative burdens that come with the compliance that is required, especially in our VAT and excise taxes, are worth it to begin with, because that would be helpful about whether passing tax laws is essential, and the administrative burden of tax laws are measured against the revenues that are raised. What do you think?
Yes, thank you, Kwame. That's a very good way of for us to challenge Parliament, because it's yes, for every new rule that you propose, there should be a subsequent rule that needs to be taken out, and these can also be added by other guardrails. So, for example, you cannot say touch specific rules that you've introduced before that medium term revenue strategy ends. So, like, you cannot reintroduce, so you cannot have amendments and subsequent amendments on a specific rule within within 3 or 4 years. So that you say, for example, if you introduce an anti-avoidance rule, you cannot reintroduce two subsequent or three subsequent rules in the next finance bill or in the next finance bill unless those 3 years have lapsed. So that's and then the other things that needs to be before Parliament years or a treasury submits a copy of the finance bill, there should always be a compliance, a burden report, and an complexity, something that a report that has details by requiring whether it's Parliamentary Budget Office or one of the specific entities within the institutional structure of Parliament to bring those administrative complexities into light. That could mean, for example, a study, a validation with and then external actors, and then that is debated before the proposals of the finance bill come forward. And then another thing is there needs to be a better way in which Parliament should still amend specific laws, and it should not be on a time bound. It should not be on a time bound exercise to say, for example, pass the finance bill. We all know, even if the finance bill is not passed, that revenue will still be collected. We've seen there are specific years where Kenya has not had a finance bill, even up to November, even up to January, even for COVID. So, for example, even if to specific, so because revenue will still be collected, because a tax code, which is an amalgamation of all those tax laws, but still exists and they're still on the books. So it's not like, for example, if Parliament fails to pass a finance bill before June 30th, before July 1st, that revenue will be the revenue will not be collected. So this rush, and then again, whether first that issue of omnibus bill needs to be dealt with, that question on how Parliament engages with the with various provisions. So it should require evidence that if you are introducing a tax measure, that evidence for why that tax measure should be there in place should be introduced. Should not be just objects to say, for example, these tax provisions would do that. And then legislative drafting, you even hear arguments that it needs the way finance bills are drafted should be in a way that allows. So you hear an argument say, for example, that there is a final excise tax on smartphones and it's supposed to eliminate 3 or 4 other taxes. But when you look at the actual draft on the books, on the actual draft, it doesn't repeal those other taxes. So those arguments need to go in a way that allows Parliament is the way Parliament engages is the way the cleaning of that language in the tax laws. Then there should be a measure on how also the entire tax laws are reduced. That, for example, we counted last time an estimate of close to 15,000 pages of tax code. 15,000, more than 15,000 words on the tax code. And there needs to be a way to reduce those number of pages to at least say not more than the size of the Constitution. All tax laws, whether it's miscellaneous, all the major tax heads, all the major revenues provisions should not go beyond the maximum, it should even be lower than the Constitution. So that allows this, so that there's some efficiency, there's even some level of, and then some level of that balance that Parliament seeks to, that Parliament is aware that these rules that are being made are not just to raise revenues, but it's also rules that people are able to. And then another thing are able to deal with. So one of the things, so like for the issue of the VAT, we counted since the commencement of the VAT Act, there's been no month when the tax refunds, National Treasury has made all the tax refunds on time, so that nobody owes refunds from government, and everybody else. So there's been no month. So that shows you that some of these rules do not matter. These rules are just for the sake of raising revenue, but are not for this for economic efficiency or any other aspect. So just to end up with this is that the modern global economy is more complex. Value chains are in several parts of the world. It means that for Kenyan firms to compete, they must be able to raise more investment, be able to bring more goods and finish them as they send them to other markets. And that means a lot of it, tax policy will have a bigger role to play in how both administrative procedures, the economic and legal incidences, and also the way we think about the main goal. What is the policy objective? Is it to raise more revenue? Is it at the expense of markets? Or is it to raise more employment? So what is the policy objective? Because that, in the end, it comes back to that, because here it seems that the bigger question is to raise more government revenue, not the foundational economic problem, which is to increase the size of the labor market and to raise output. So thank you so much. This is part of the Industry 254. We intend to do issues related to manufacturing in the subsequent areas. Back to you, Kwame.
Okay, thank you very much, Leo, for that. Yes, for that clarification. But it's very, very clear that if you have a broken tax system, and one that's especially this broken, I think it has two consequences. One, it creates incentives for the informal sector to build. So obviously the expansion of Kenyan farms is undermined, not by anything external, but basically the policy choices that are taken, especially fiscal policy choices. That's one that's clear. I think one of the things that has come very clear to me, especially with the respect to excise tax and VAT, is maybe government ought to consider, fine, especially for VAT, whether those distinctions between a standard rate. Now we have a standard rate, we have an 8%, a standard rate at 16, we have an 8% rate which applies only to fuel. We have two rates, the standard rate, the special rate for fuel, which will apply until, I think it's supposed to apply until September this year, or maybe sooner. And then we have the exempt, and then we have the zero rated. So now Kenya has four VAT bans are completely crazy, completely crazy. But regardless of that, it's clear that a reform is required. And one of the ways to simply set it, again, borrowing from the sensible and high quality economic analysis that has been done by Nobel Prize winners, is perhaps to consider just as sales tax. VAT is light, it gives a lot of jobs to people, including people like ourselves who make commentaries about what its effects are. Many accountants, I mean, you need serious accounting energy and knowledge to be able to make sense of what all that means for any enterprise or firm. But the inefficiencies that it drags onto the economy, in my view, are enormous. And it's easy to see, even if they're not quantified yet. But I think a big private sector shift is required to generate energy to ask the government to actually consider amending the VAT law. And one of the things is basically to have a standard, either sales tax applicable to all goods in one way, preventing hopefully the distortions and the complexity that we're talking about, or to simply reduce the VAT to one by half or some to 10% and then expand it across all goods to prevent all that kind. Because it's clear to me that with a growing bill of 2.5 billion per month, for the rest of time, if VAT continues to sit here, I mean, the debt that is generated is not just substantial and government is struggling to pay, but at the same time, the amount of burdens that is imposed on businesses and consumers is not justified for the kind of money that government is trying to find. So a solution is required. But in the end, it points to the way tax policy in Kenya is done. I mean, we have the medium-term tax policy, which, to be honest, in my view, is very, very woolly. A tax policy can be written, in my view, in 5 pages or less, talking about efficiencies in tax collection, the principles that apply, and obviously how that discretion might be applied. But as we say here, Parliament needs to be more alert to what the consequences of the fiscal policy choices that they make, especially the tax and finance bits that they do have, and unpredictability, administrative burdens, and obviously the burden on taxation and the shrinking of markets that it has. So ladies and gentlemen, on behalf of the Institute of Economic Affairs, I thank you very much for being here and for sitting and having this discussion with me. I'd like us to clap for Leo as well, who's made significantly educated us by allowing us to learn much, much more about what the consequences of this are following on the tax bills